Well, this was a very finely balanced speech. I think he had to emphasize that the Fed is still looking for more data. At the same time, he had to acknowledge the fact that, there's a lot of pressure on the Fed to essentially acquiesce to the government and cut rates. So he had to nod to both sides, saying the Fed will do what it has to do, but it's not ignoring the government. And that's why I think it was actually quite masterful the way he managed to sway expectations slightly more towards a cut, but with a subtle change in words. What he said was, and I'm going to read this, the shifting balance of risks may warrant adjusting our policy stance. Note the word may. That means he's not committing to it, but he's saying we're bending a little more towards cutting in September.
So that balance of risk shifting, I think, toward the possibility of a cut, I think specifically with respect to labor. And he did talk about the balance of risk on labor tilting to the downside, even as inflation risk tilts to the upside. What's your take on the shape of the U.S. labor market today?
Well, it does look like it's softening. Now, you don't see layoffs in a big way yet. What you do see is the pace of hiring has been relatively slow, and partly because of the fact that immigration has come down a lot, the labor force is not growing so much. So even with the low pace of hiring, you're not seeing unemployment go up. What that means, I think, from his perspective, is that the labor market is weak enough that he doesn't see a substantial increase because of second-round effects of inflation. Now, this is central bank speak for saying, look, tariffs are going to push inflation up, but what we really worry about is the worker asking for higher wages, which creates more inflation down the line. He discounted that in his speech, saying he doesn't see that will push inflation up because the labor market is relatively weak at this point.
At the same time, we do have core inflation that's well above that 2% target that he reiterated once again. When was the last time that the Federal Reserve cut rates with the core inflation at that level?
Well, it's not just that it is at that level. It is that it hasn't budged downwards for quite some time. In fact, the last readings look like they're going upwards. That was the point where I concluded that he was being quite dovish, because there's no mention of the fact that we haven't seen a downward adjustment in inflation. Typically, central banks cut when they see inflation coming down. That puts a lot of weight on weakness in the labor market, bringing inflation down further into the Fed's comfort zone. There is no evidence for that at this point. It is a hope.
We have ambiguous or maybe even conflicting data on inflation on the one hand, labor on the other, and that's against the backdrop of a fair amount of uncertainty. Particularly uncertainty because the Trump administration is really quite explicitly trying to change the narrative, particularly with tariffs. What about the risk of tariffs? How much have we seen? How much of a risk does it pose?
Well, we haven't seen a lot, though one should note, and Chair Powell noted, that goods inflation, which was coming down, it was not inflation, the goods prices were coming down, so inflation was negative. That has shifted around to a positive rate of inflation on goods. We still haven't seen a full pass-through of the tariffs into prices. That is coming. And the chair said, look, we think it is going to be a one-off. What we worry about is it either feeding into inflationary expectations, that is, people think inflation is going to be higher, or it feeds into wages through a tight labor market. He discounted the tight labor market issue, but he said inflationary expectations, we're going to be watching that, and we certainly will do what it takes to keep inflationary expectations anchored. Broadly, he seemed to suggest that tariffs were manageable. What he didn't talk about, as we've said before, is that he didn't talk about the fact that inflation is way higher than the Fed should be comfortable with.
As you noted, Professor, he was very careful in saying that the shifting risks won't, not necessarily, but may warrant an adjustment. At the same time, the markets certainly took it as almost a guarantee in September there's going to be a cut. Given where all the data are and what he had to say, what do you think the Fed should be doing?
Well, I think he's bought the Fed some room. What will be critical are the August labor market numbers. If they look as weak as the July numbers looked, the Fed will have a cast iron case for cutting. If, however, you see again a shift back towards higher employment numbers, I think the Fed will really be conflicted at that point.
The part of Chair Powell's speech that got the most attention, certainly from the markets, was the part about what's likely to happen in September, where we are on cutting. But there was another half of the speech which had to do with the so-called framework, which the Fed tends to revisit every 5 years or so. And of course, last time was August of 2020. It was a very different world, as he noted in his speech. What did you take about what he had to say about how they're changing that framework?
Well, it was very interesting. He essentially said we were tackling a problem which no longer is that important, which was the fact that the Fed had been tackling low inflation for a long time. Inflation was lower than where the Fed wanted it to be. And the Fed essentially was at what they call the effective lower bound. It couldn't cut interest rates anymore. And in that kind of environment, really the objective of the framework that the Fed brought in then was to push inflation up. And just a few months after they brought that new framework in 2020, the problem was exactly the opposite, which is high inflation. And the Fed now had to bring inflation down. And essentially what Chair Powell said was, look, we had the right framework for the wrong problem. And at this point, what we're trying to do is move back to our old framework.
And finally, Professor, this was his last speech, by all appearances, at Jackson Hole. As he noted, it was his 8th straight speech. Reflect on his legacy, and particularly, I really remember, it wasn't that long ago we were talking about hard landing, soft landing, a lot of people saying we're going to have a recession. In retrospect, it looks like the soft landing happened under his watch.
Well, yes, and I think, unfortunately, he will not get as much credit as he should for navigating the Fed through very difficult times towards what seemed like a soft landing at the beginning of this year. Of course, the volatility from the new administration's policies has put that into some question. But from the Fed's perspective, after the sort of mistake that was made in the early days of the pandemic in thinking the inflation then would be transitory, the Fed did a very creditable job in getting things back into line. So one, he should get more credit for that. The second, I think, is that he's displayed immense calm and equanimity at a time when the Fed has been pummeled by outside forces. I think that's also very creditable, that he has led the Fed from the front, but also shown that, despite all the pressures from outside, he can focus and offer a reasonable view of what a central bank should do. That may also, in the years to come, be seen as a very important legacy. He's led with honor, and he's been very careful, but also, reflected great integrity while leading the Fed.